All righty. So we're on to I believe it's the eighth week now. Just had the midterm. Start out with a midterm review, and then we'll go through some topics, primarily around insurance. So, anyway, life insurance. First exam, pretty straightforward, I think. I don't think there should have been too many surprises. Final will be a lot like it. So, um, things that we're talking about, opportunity cost, as I mentioned, opportunity cost is huge. It's how you live within your budget. You realize that if you're doing one thing, you can't be doing another, or if you're spending money on one thing, it's going to preclude you from doing something else. So, spending versus investing. And anyway, once you kind of sort that out, um, it has all sorts of applications and not only personal finance, but the rest of your life. Another example, giving up a movie in order. Sure, it can be time, it can be money, it can be lots of things. When should you retire? As soon as possible. Primarily due to the time value of money, but also because these things sneak up on people and or life, happens. And like I say, a lot of times you can borrow against your retirement funds for hardships and other things. But again, those funds need to be there. And what you know about compound interest is huge. So it doesn't take a whole lot to get things going, and then it'll start growing. If your spending exceeds the amount of money available, yeah, somehow you need to reduce your spending. Sell some of your assets, kind of a short-term fix. Same with work hours, second job. You can only do that for so long, and something something needs to change. I know it's not easy, but it's it's what has to be done. Liquid assets. So we know liquid is cash. So obviously, cash is obviously the most liquid of all. Real estate is always the example of not very liquid. I've got a piece of property for sale right now, and I'm certainly not, counting my chickens. I'm not planning to spend that money anytime soon. Actually, it's been on the market for quite a long time. But I kind of overpriced it and didn't really market it. But you know, there's always somebody with raw land. It's always interesting the people who actually end up buying it. It's not quite as it's very illiquid even for real estate. Student loans, car loans, long term. Why? Because they're over a year, right? Every one of these is you don't get a car loan for 6 months or a student loan. They're always longer term. So, and you owe it. So that puts it in the liability category. Um, so measure a person's wealth. Yeah, it's not how much stuff they got. It's how much stuff they actually not own, but whatever. I mean, owning is one portion of it. If they're assets that are appreciating, then well, that's good stuff to own. But if it's boats and cars and stuff like that, that's kind of fun. But yeah, your net worth's going to be decreasing as those things depreciate, which is kind of on the wrong side of things. Why is it important to monitor your debt level? Yeah, so that you can service it. You look at especially like different nations. I mean, the amount of interest they pay. Even the U.S. budget, the people think, oh, we need to cut back on this, cut back on that. Most of it's already allocated, and unfortunately, a lot of it is allocated to just paying the interest on the existing debt. So kind of scary. Money you receive today is worth more than money in the future, right? Because that's the compounded rate. If you invest it properly, you'll get, um, you know, your money will grow and grow. Time value of money, same question. It's you know going to be worth more than the dollar received tomorrow because you'll have time to work on it. So again, compound interest. I mean, there's a reason why there's some redundancy here because compound interest. Oh yeah, I understand compound interest, but when it actually starts to accrue and you see your accounts start to go, people are always astounded on a good way, in a good way that the amount is actually there. Also, if you're in debt, yeah, it's easy for your debt to run away from you. If you're just making minimum payments on something, think it's kind of silly. Um, Head of household, if you're when you're filing your taxes, obviously you want to be out of that single category because that's going to be the highest tax rate. So if you're single but you have a child or somebody that you can claim as a dependent, that is a good thing. So boom. Doesn't so much have anything to do with a home. In fact, it's got nothing to do with a home. You can be a renter and be a head of household. It doesn't need to be, a house you own. Um, Simple math problem. Yep, bought it for that price, sold it for 35. Boom, she made 15,000. Took longer than a year, so it's a long term. So big significance of this is it's going to be taxed at roughly around 15%. If it was, made in less than a year, it's going to be taxed as if it's income, which believe me is painful. When you get a bunch of money coming in a single year, all of a sudden you're up in this, kind of rich person category in terms of tax brackets. And so that final amount of money you're getting, you'll lose at least 30%. So double. Purchasing item on credit will help reduce your tax bill. So right now it's a home. There are certain automobiles. If somebody mistakenly put automobile, let me know. Maybe I'll give you partial credit. A home's always been in that category. Automobiles, you got to kind of jump through some hoops. It's got to be American-made car. It's got to be new. A lot of restrictions, but it is a positive. Anything to reduce taxes is a positive. Financial institutions, loans, funds, that's how they make their money, right? They loan the funds at a higher rate, and then they pay less to a depositor. So they make a little bit of money. They loan it out for, charge you like 8%, and then they only pay you a fraction of a percent. That's how they make their money. Ability to cover short-term cash, liquidity again. Short-term cash, operative words. Disadvantage of using credit for a source of, you got to pay it off. Yep. If you don't pay it off in that billing cycle, you're going to start accruing finance charges. But if you do, woohoo, it's free. Stopping payment on a check. Yep. If the check is cleared, it's water under the bridge. There's nothing that can be done. That check's already been presented. It's already been cashed, and it's cleared. So, but no, a stop payment is a different thing. Arrangement that protects the customer writes a check that is an overdraft. Good to have. Good to have. And another reason you probably need to have a credit card. So again, I'm not trying to get you to abuse credit, especially if you can't do it, but to have a card just kind of, in a drawer somewhere is not a bad thing. All the following situations, valid reasons. Yeah, if you're just going day to day, again, you're acting like our government, which is not necessarily responsible. Using a credit card frequently, pay off that balance, and that way you escape paying any interest on that. Cash advances, they are not a debit card. They're not an ATM card. They will hit you with about 10% up front, and they'll start charging you interest right off the bat. There is no grace period. There's no escaping that. Following statements true about Visa, MasterCard, source of an emergency funds. Yep, they can be used, if you have the resource to pay them off. Again, I use an Amex card for most things because they pay me 4% back, which is, a fair amount. They pay it to me in crypto, but anyway, I'm a believer in crypto, so that's even better than cash. But a lot of places, Costco, different places you'll go into, credit card doesn't work, and it's like, we don't take Amex because American Express charges the vendor a percent or two more than, a percent more than Visa and MasterCard. Finance charges only apply to the balances that were not paid in full, and that's true. APR, annual percentage rate. So, had somebody miss this? We'll look into that. I'll check the student's answer, but annual percentage rate is the one you need. It's it excludes some of these hidden fees, some of the teaser fees. If it's going to be quoted as an APR, that has a specific legal definition. which makes comparison possible. If it's a interest rate that's quoted without saying APR behind it, you don't know what you got. There may be other fees and stuff involved. Good practice, review your statement online. Yes. Fraudulent charges, duplicate errors, and then also to kind of do a reverse budgeting type thing. But again, any sort of, man, I had somebody try and hack into my Coinbase account this week. It was quite serious. They changed the password, they changed the authenticator. They were almost there, but I had, a couple other two-factor authentication things in place that are even enhanced more now. But yeah, the fraudsters are out there, and they will certainly put some extra charges on your account or take your account if they can. Collateral, that is what you put up. That's what secures a loan. It's what gives the creditor, makes them able to give you a low interest rate or the lowest interest rate that they would possibly give you if they have some recourse in case you flake out. So the loan with the lowest interest rate, again, collateral, you don't want, a signature loan, a line of credit. Some of those things sound cool, but what you're really concerned with is the rate. So cosigner, as I made my point, I think, don't do it. The lender may not seize the assets of the cosigner. Well, that's one of these accept questions. But anyway, yeah, they will definitely seize your asset. In fact, they may leave the person who actually took out the loan and initiated. Time is money. They're not going to mess around with somebody who's a deadbeat. But you, on the other hand, you qualified as a cosigner. You had the resources, so it's worth their effort to come after you because there's something to be had. Purchasing a home, what costs? So the real estate commission, that's a seller expense. Now again, they can pass it on to you and all that other stuff, but for the most part, if you're looking for a home, it's usually recommended to work with an agent because it's not costing you. Disadvantage of a neighborhood or homeowners association, yeah, they can restrict, but they also restrict your neighbors. So it's a two-edged sword. Fixed mortgage, it's a beautiful thing because it's going to stay exactly the same. So, you can get a variable and all that stuff. And like I say, depending on your financial situation, you might do that, but only do that if you're pretty comfortably make that payment. If you're on the very edge and you're using the adjustable rate mortgage to just squeak in and try and buy that home, keep in mind that if the rate goes up, it's going to go from being barely affordable to not affordable at all, and you lose everything in bankruptcy, and it just spirals. ARM, so that's what I'm talking about here, adjustable rate mortgage. Typically a lower interest rate, but typically a little harder to qualify for too, because they know. But anyway, but sometimes like right now when rates are higher and you're looking for a way, but again, if you're on the very ragged edge of being able to afford it, I would not suggest it. We talked about insurance. Yeah, ignoring risk is not something that you should do. You have to avoid it. You're acknowledging the risk and you avoid it. You're going to acknowledge the risk and just say, okay, I can live with this. But to ignore it just means you're not even cognizant, or you can pay a premium and have somebody else take that risk. Comprehensive, that covers all the cats and dogs, all the weird stuff, wind, hail, fire. Deductible comes out of pocket. So if you have $10,000 worth of damage, but see, like I had a home problem, my deductible is $7,500. Oof. So if it's like an $8,000 claim, am I going to file a claim to try and, that they would only give me $500. and they've put me on their blacklist. They're gonna up my payments, premiums. So, which the following is not covered: standard homeowners, that'd be flood insurance, right? Yep, because it happens to everybody at once. Insurance doesn't work that way. Cover personal articles, personal property floater. Homeowners insurance, yep, you can increase that deductible. You can go with a $7,500 deductible. Seems like a great idea until, uh-oh, you actually need it. I mean, to be true, it was probably going to be a $5,000 or $2,500 deductible. So anyway, I can fix things. I'll get it done. Health insurance is expensive, but the good news, most people get it through their employer. So if you have to go out there on the open market, yeah, that can get quite ugly. And man, insurance companies, that's just a, you know. Anyway, obviously they're not a popular group of people, but mm, it's a tough situation. Okay, so if you have questions or you think you've had an issue with one of those questions on the test and you think you got it right, let me know. Now you've got the questions and the answers, and I thought I had checked the block on, when presenting the test where it's supposed to present you the correct answers, which it should have done. But anyway, if I screwed that one up, now you have basically the answer key, so you can go back and double check. Life insurance. Life insurance, it's like everything else here. I kind of, it's not a minefield, but it is kind of a contentious issue because people have different opinions on it. And so I'm going to give you, what I think is a legitimate opinion. And obviously, that's my opinion. I'm thinking it's the best, but different people, especially if you're somebody who sells insurance, there's a lot of money to be made by selling some complex, elaborate life insurance policies, where in actuality, most people can do just fine with term life insurance, which means just you pay for a specified time. But anyway, philosophically, if you know the purpose of life insurance, you can come to better decisions regarding it. So this will make more sense as I go along. Role of life insurance, yep, financial support for dependents. So clearly, in order to collect life insurance, you have to be passed on, and so it's going to leave money for the heirs, or hell, it could even go to charity, whatever you want to do with it. That's up to you. But and yeah, sometimes people do ignore it because they don't want to think about death and the rest of it. And they're like, yeah, why do I want to pay premiums for something I might not need? So, or you certainly will never be there for it. Role of the insurance, because it's a complex, regulated industry. You can't just have people offering insurance and not have the resources behind them to pay for it. So it's heavily regulated, and there's been some scams and other things. So yeah, there's registered life insurance agents who typically will sell, especially the more complex products. And yeah, it's they do benefit from commission. So the more they sell, they are definitely incentivized to give you some of the more complex products. Applying for life insurance, they want all the data they can get on you. So this is where big data and personal privacy does become an issue. If there is something in your medical history and they can find out about it, they are certainly going to seek it out, and especially if you make it available to them. And there are some privacy laws, but if you've put it out there in the open market, well, or it's self-reported, that's going to be a situation that they can act upon. They want to know, what your propensity, and with scary accuracy, they can look at your lifestyle and your factors and kind of size up when you might die, and they'll look at it from an investment standpoint, going, how high does this premium need to be, and when do we need to think about canceling this person, and the rest of it. But my point is, philosophically, on life insurance, consider why you need life insurance. Getting back to, taking care of your heirs. If you're a single person, you don't need life insurance. If you're a young person with a young family and a house and a bunch of debts and a non-working spouse, oh my God, you need all kinds of life insurance. But if you're that same person, fast forward 20 years in your life, you more or less have paid off the house. You were a good boy and you saved for your retirement and everything else, and you've got, a nest egg built up. Your children, did or did not go to college, but you're not having to save for that anymore. That ship has sailed. You don't need a whole lot of insurance, if any. In fact, you're probably better off investing that money that you would be spending on insurance. So, yeah. The thing about life insurance companies is they're not necessarily investment companies. They're not good investment companies, I should say, because they have to be very cautious with their investments. They're very highly regulated. So if you give 100 grand to an investment, typical brokerage, and put in a wide range of accounts, you'll get, probably at least 10% on your money. You put it with a life insurance product and you're not going to get anywhere near that. So, you got to keep things sort of separate. So there is sort of a solution here, and this is where it gets into personal preferences and stuff. And I'll support this to a certain extent with, some of the other personal finance people that are out there if they're already experts. But anyway, term life insurance is a pretty easy proposition. What you do is you give this company a certain amount of money, and you say, hey, if I die over the next 10 years, I need basically $1 million to get through this situation, for the family to be made right, pay off the house, put a little away for savings, give the spouse, a little transition time, some money for college, stuff like that. It's all good. And because typically you're young and it's a easy contract to understand, we're not dealing with a lot of agents or even, you do this stuff online and you just pay a quarterly payment and it's super affordable and you get a huge amount of insurance for it's put it, frankly, it's good value. Determinants, yeah, the longer the term, the longer they have to guarantee that they're going to pay. Yeah, they're going to charge more. Older the policy, well, yeah, you're getting closer to your expiration date. Greater amount of insurance, the higher the premium, which is logical, linear. Males and females, males do tend to do things at the extremes and die more frequently and are in professions that die more frequently. So that's only fair. Higher smokers, yeah, I think you've been told that once or twice in your life that that's probably not a good idea. Premiums higher for those with medical problems, certainly. So that's where they want to know, what your issues are. And yeah, so here it's like super cheap, annual premiums. And I'll show a current thing. This is just kind of an oversimplified chart, but you can see, wait a minute, all of a sudden it gets exceedingly high and unaffordable. Who cares? I don't need the insurance at that point. I want to get that money. If you think I'm going to dump, thousands of dollars in a term life insurance policy, that's not good value. You're better off investing that in something else and just a proper investment, and you will do better over the long run. Coverage levels. So yeah, here's the age thing going on. Here's male versus female. Smoker versus non-smoker. They really don't like smokers. So, but I'm sure they've got the numbers. I mean, it's nothing personal. They've got the numbers. And it's also maybe an indicator. I don't know. The same guy, who smokes is probably somebody who drives a bitching Camaro way too fast or does something else. There's certain indicators, it's studies and all this other stuff. The correlation versus causation and all that stuff. I mean, there's a study they found that loud music basically cause cancer, and the study was based upon cocktail servers, waitresses, whatever you like to call them, working in loud rock clubs, and they determined they had a higher rate of cancer. Well, yeah. Did they look at who's smoking? Did they look at if they're secondhand smoking? Did they look if, it's there's so many factors that you can't, anyway. So, but anyway, they there's people who smoke categorically do tend to die earlier for probably a number of factors in addition to smoking. But anyway, it's going to price the insurance more. Decreasing term. So there's different ways they can do this. They can set. You could say, hey, we're going to charge you literally $20 a month, for insurance, and you get $1 million coverage when you're 20. Okay, and they can say, okay, we're going to keep charging you $20 a month for 10 years, but as you get older, your $1 million coverage goes down a little bit each year that you get older. So, if you're in your 20s, it's still going to be super low, but they can keep the premium the same and just reduce the amount of coverage. Or anyway, it's all marketing, however they want to structure it. You'll see mortgage life insurance, you'll see credit life insurance. And basically what that is, that's a self-funded term policy. They make it sound like the lender will make it sound like they're giving you this additional benefit. And yeah, but you're the one actually paying for the policy. And so on the event of your death, the home is paid off. And you can see from a mortgage company's perspective, this makes life much easier for them because then they're not in some wrestling match at the funeral with the grieving spouse trying to get that mortgage payment out of them. It's the person died. Oh, we just execute that policy and it's done. There's actually a thing called peasants policies. Walmart got in trouble for this. In fact, I've got a friend he's got a very questionable lifestyle. Anyway, you can take out a policy on somebody else, make yourself the beneficiary and make the payments. And Walmart was actually doing that amongst their employees. It was kind of a scandal because they realized that, the sketchy nature of the people that they were hiring tended to die earlier and therefore were a decent investment where they'd buy these term life insurance policies. I guess I'm laughing. That's probably inappropriate. But anyway, they buy these life insurance policy and their employee died. They cashed in the policy. And anyway, it must have been making money for them. They're not stupid. They wouldn't have done it. But anyway, it looked inappropriate when it was all brought to light. I think they don't do that anymore. Group life insurance, always cheaper. If you go and get individual life insurance, approach a company that can get more expensive. So, it's funny. I did this with, there was one of the wars was coming up. I think we were going to Kosovo or something. And I was flying Weasels at the time, which was semi high risk in terms of fighter missions. And I took out 3 separate $1 million policies on myself. And you can see, here's the numbers for a term life insurance policy. Not much. I was probably 40. So they were, no, that's for a whole life. See, that is prohibitive. No, I took out one of these. Yeah, $49. It's about $50 per policy. And I took them out for like 1 or 2 years just in that time. And yeah, if I would have got schwacked by a missile, the wife and kids would have had a couple, $3 million. But boy, did that concern the life insurance companies. They sent out this lady who may or may not have been an actual nurse. She was dressed up, a little nurse's outfit, and she was basically a phlebotomist, person who comes out and takes your blood. And they just wanted to get eyes on me to make sure I was actually living or whatever. They were very suspicious of somebody taking out multiple policies over a short term. And they asked me all sorts of crazy things, do you scuba dive? Do you do this? Do you do that? And actually, I do scuba dive, but I wasn't scuba diving at the time. So anyway, I did, I'd parachute, at least not intentionally. And so, yeah, I got the policies. But the funny thing was, they didn't ask, hey, are you happening to go off to a war in another week or two? That just never came up, and I didn't offer it. So anyway, got the policies. So getting back to the big picture here, what I talked about on the preceding slides was term life insurance. And you can see that it was fairly straightforward. And look at the affordability. I mean, now you're not going to be doing it when you're 70 years old. That's where this whole, by about 50 or so, you should have figured this out and should have some money kind of set aside. But when you're in your 30s, Yeah, $30 or 24 for a female to get $1 million worth of coverage. And I pulled this today. Aflac's a reputable insurance company, but you can see how expensive it gets for a whole life insurance policy. Now, a whole life is, yeah, there's a bunch of confusing names they'll offer for it, but the point is that it's a like a hybrid insurance investment thing. It has a cash value, which means they're investing the money, but they're taking a lot of money. I mean, you're basically giving up about $1,000 a month. And now, if you're going to go blow that money on something, that's one thing. But let's say, 30 versus 920. Let's say this $1,000 that you're not spending on your whole life insurance policy, if you invest that in just the stock market or even real estate or something else, you are going to have a whole lot more money than that life insurance policy ever would have had. I mean, unless you die quick. But anyway, so whole life insurance companies, that person who sells you the policy, they're going to get a commission, not only up front, but every time you reinvest, every time you pay this, $900 premium. I don't know, probably 100 of that's going to go back to that schlub, that agent that sold it to you on the first day. It's very costly. So whole life premiums, yeah, same sort of things. If you're older or poor health, those numbers are going to change. Forms a whole life. Yep. Limited payment policy, pay premiums over specified time, insured for entire life. So you may only pay, that 920 or whatever it is for, the first whatever number of years. And let's say you hit age 60, you don't have to pay anymore because they already got so much of your money. They don't want to be, not that they aren't greedy, but they don't need to take any more. Comparison to term, higher premiums, certainly. Accumulate savings, but yeah, not in great investments though. Remain constant. So again, they'll sell you on this, comfort factor that, oh, you don't have to worry about it, and it's going to have value, and anyway. And they have the salespeople. Term life, you're not going to meet a term life salesman. There's just not enough money in it. Nobody's going to go out and push it too awful hard. But whole life, oh, certainly, there's a ton of money to be made if you can start lining up commissions. So, yeah, they'll take you out to dinner. They'll, spend a lot of time with you. They'll discuss your family and everything. I mean, all kinds of things because they can make some money from you if they can get you on side. Universal life. So they'll have these universal variable. I mean, they're all just these ambiguous terms that are like, well, what exactly does that mean? And again, it's marketing, so that doesn't mean there's not necessarily universal or universal agreed on definitions. One company's policy, they'll maybe call it something else under one insurance agency. So there's not necessarily legal definitions for them, but they're kind of vague. But one thing that they do try to do is that they recognize that, the smarter amongst us will go, wait a minute, this isn't a great investment. What if the stock market goes up? I'd rather have my funds invested in the stock market. It's like, oh, no. We also, we put them in various types of investments. Under the variable life, you can also enjoy that stock market appreciation to a certain extent, not to the same level. How much life insurance do you need? So I already kind of alluded to this before, where you kind of look at, you take stock of your situation. You say, okay, I've got, spouse, I got kids, I got a house that's just paid off. My spouse didn't go to college because they were pushing me through college, and so, if I pass, then they may want to go back to school, but they aren't going to be able to because I'm dead. No. So anyway, you go through and you go, wow, I'm leaving these people with a kind of a bad situation if I happen to pass. So I'm going to take out a fair amount of money and have, you do the math and you go, oh, I think I need about $1 million. And so you take the $1 million policy or 1.5 or 800,000, whatever it is you need. Or you can come up with these other methods that I think this one is just goofy. I don't even know why. Well, they talk about it. You'll see it on some websites, and I think it's just silly. Income method. 10 times your income. Well, what if you're like a single guy? You're leaving all this money to who? And why? But conversely, what if you're somebody who really needs a lot of, insurance and you're making 40 grand, you're going to leave them 400 grand. That's not great. So anyway, yeah, doesn't consider the circumstances. So it's flawed from the get-go. Budget method. This is more reasonable. Yeah, needs. So living expenses, special future expenses, college, things like that, big debt on a house, marketability. So this is more complete. This is, but we don't have much in savings right now. So yeah, it's important that we keep that house and all the rest of it. So that is reasonable. Now, the internet's no magic, whatever. Use the internet to determine. Now, I want to know what the factors are. And they're going to be using some sort of needs type thing. Limitations, family income. Well, these are all things that you can, figure for. Debt level could increase. Yeah, there's some unknowns in there, so you pad it by a little bit. But that's not, I wouldn't say that's a limitation. That's just a consideration, more or less. Yeah, so keep in mind, you start roaming around on the internet and the marketing is definitely going to be associated with like, oh, term life is horrible. You need whole life. You need this. You need to call us right now and let us, hold your hand and sell you something you may or may not need. So needs and dreams. Yeah. I don't know. I don't know that you need to be overly conservative. If we're talking a policy, at least when you're young, that you get for $30, maybe include a few dreams. Make your funeral a little bit more pleasant. That you're not leaving them destitute. Beneficiary, that's the person who gets the policy. That's the person who gets the money. Grace period. Sometimes there's a grace period on both sides. There's a grace period in terms of you miss a few bills, they can't cancel you right off. Or if, you just got the insurance policy and you die within a week or something, they could also cut you off. So again, on those term policies, I made sure that they were in force from basically day one. But there may be a situation where they say, hey, we're not paying for, some sort of pre-existing condition. If you had, stage whatever cancer and you didn't acknowledge that, they may say, that was a fraudulent application, or not paying it. Living benefits. This is kind of cool. Let's say you are that person who's had this insurance policy for some time, and you got, a cancer that's not going to end well, and you're struggling. You can't even work anymore. You're going to lose the house, but as soon as you die, the policy's in force. Well, the better answer to that is, hey, I've got $1 million policy. How about, $100,000 is paid before my death, with the suitable note from your doctor saying, yeah, this person's not going to make it. And that way, you keep current on your bills, and maybe you go for a trip, the big last family hurrah. And anyway, there's things that can be done. So those are living benefits. Non-forfeiture clause. Yeah, this gets to do with whole life. Sometimes if you terminate it, if you want to cancel it, rethink it. You can take loans since there's a cash to value in a whole life policy, incontestability clause. So this gets into you told us, but you died of cancer at 3 years. Hey, it's not contestable. I made it 3 years more, so you can't fight it. Renewability, this has to do with term, if you want to keep updating your term. But again, you're going to get to a certain point, and let's say you're in your 50s or your 60s, and all of a sudden those policies are starting to get expensive. What do? Cancel them. You don't, You don't need to be paying for $1 million policy because it's not going to be cost effective at that point. Unless you're, some late whatever, somebody who's having children in their 50s, but not for most of us. Conversion options, convert term life into whole life. Oh, they certainly like that. They'll make that available to you, I guarantee you. Settlement options, different ways. So this gets into the lump sum, spread over payments. How is it going to be settled? So lump sum, installments. Interest payments. This gets into whole life type policies. Or if there's a policy that's being paid out and there's, the amount of money is going to be dispersed over time, well, you should be getting interest on that money that's yet to be dispersed. Selecting the life insurance policy. So what you'll see when we get into investments, and you may have heard some of these names before, in investments, you've got, Standard & Poor's is a rating agency. In bonds, you've got Fitch and a couple other people who get involved in that. In insurance, you've got AM Best. So there are other companies that do this stuff. But what you need in any sort of financial realm is you need sort of a third party who's not part of the company. If you ask the insurance company themselves whether they're financially viable and a great company, obviously the answer is going to be, oh, of course, yes. But what you want is an independent person, a fiduciary person who's not, involved, going to give you an unbiased recommendation. And so that company is AM Best and companies like it that are stood up. All right, so that covers kind of life insurance. You'll see some videos I'll put out there, and it'll sort of explain things. One's an old, Suze Orman. She used to be a thing back in the day. She had a popular, insurance or personal finance kind of show, and then also I think some of the other personal finance guru kind of guys, Dave Ramsey, he would definitely be on board with term versus whole life. Most people who are giving you an honest opinion will come to the conclusion that you need term. But anyway, it's up to you. Investing fundamentals. We're just going to go over this just at the wave tops right here, just real quick. We'll spend more time on all kinds of investments here in the upcoming weeks. So let's look at one of the first things. Investing, live within your means. So obviously that opportunity cost that we were talking about before. Balance sheet, know where your money's going. High interest debt. If you've got credit card debt and you want to invest, no, you're not going to do as well in the investing if you're still have credit card debt. It's really hard to match the amount of money that you're paying on credit cards in terms of interest. So you got to pay those off first, and then you can start investing. Ensure adequate liquidity. Certainly don't get in over your head, and don't use money that you can't afford to basically lose. I mean, I'm deep into crypto, and I haven't lost any money on crypto, but I don't use borrowed money to buy crypto, number one. And, I'm not selling crypto this week or this month, or I don't know when it's going to happen again. It'll bounce back, but it just, that sort of volatility, that's why crypto is very much not for everybody. But anyway, if I was down to my last dollar and all my money was in crypto, that would not be a good place. So, make sure you have enough money to cover your needs, and then the other money, the excess money. But again, living within your means, you gotta have excess money. At least try to. Money market securities. All right, there's a risk versus reward. Money market insured by the federal government. No risk, virtually no risk. So the reward, well, you didn't take any risk really. So your reward's not going to be huge. It's probably not even going to keep up with inflation. So Maybe they'll do better than inflation, but just barely. Now, if you're getting the stocks, now you're investing in companies. Yeah, now there's more risk involved, and so yeah, the reward should be greater. It needs to be greater. So probably about 10% typically. Two ways to make money on stocks. For most of the investing I do in smaller companies, growing companies, you're looking at capital gains. That means you buy it for 10, you sell it for 20. That's a capital gain. But more established companies, big companies, they tend to pay dividends. Big utility companies pay dividends. You're not expecting the stock price to move much, but they make profits and they pay those to the shareholders in terms of dividends. Small, companies are the ones that are paying high capital gains that are growing fast. Well, the way they achieve that growth is by expanding, and they're funding that expansion with their profits. So they make money. They don't pay it back to the shareholders. No, they build more stuff. They buy more facilities. So anyway, big established companies that have already built out their infrastructure and everything, they tend to pay dividends. And that's the reason they pay dividends, is to attract, investors, because the investors are not going to be drawn to those companies because they're not paying capital gains. The small high growth companies, the high tech ones, they're typically not paying dividends because their investors are making their money by selling. Buy high, sell low. No, buy low, sell high. Yep. Primary and secondary markets. So the notion that like you're going to buy stock in Ford or Nvidia or something like this, and you're going to go directly to the company. No, you're buying shares that are already out there on the market. You're not doing an initial public offering. You're not getting them that directly from the company. You're buying them out there on, an exchange where you're essentially buying somebody else's stock. Even if an IPO, unless you're in some privileged position, you're not going to be getting, stock directly from the company. Where it does happen sometimes is if you've got a employee stock purchase program, and that can happen. And the secondary market, that's what I was talking about before, where, you go to buy Nvidia or Ford stock and you're essentially buying it from somebody else, and that's the secondary market. Mutual funds, great sort of investment, but the reason why they're great is because let's say you're investing in you're investing in the tech sector or in AI, and you want to buy. Well, AI is not good because AI is not a great investment right now. Software, but they're not doing so well. But let's say let's say cell phones. I don't even know what the big companies are right now. Certainly, you've got Apple and Samsung, and Nokia may be coming back. But anyway, let's say you're trying to pick one of those companies and you're going to invest in Apple altogether, and you're more concentrated since you're just in a single company. Whereas if you say, "Oh, I want to invest in cell phones," for some reason you think that technology is going to take off or have a continued growth, you could buy a mutual fund that has positions with all three of those companies. And that way you don't have to be right about both cell phones growing and you picking the proper company. You can pick essentially all three companies because they're held under a mutual fund. The mutual fund, you can find a mutual fund out there that's invested in all three of those companies. So it's a way to diversify and sort of spread out your risk. But anyway, that's probably not the best example because I only gave you, three different manufacturers, three different vendors. If you're investing in the tech sector, you could buy, a mutual fund that maybe has 50 or 100 different companies in that sector and stuff. So it really gets spread out. So we'll go with a mutual fund. So we're going to spend a week or a good portion of a lecture on each one of these concepts. So, and the thing on stocks, I don't know if I really spoke. I jumped right into capital gains and stuff, but stocks, they represent an equity position. You have partial ownership in that company. So when you buy stock, let's say that company goes out of business. Well, they don't owe you anything. That was your company, and your company went out of business. Too bad. Whereas other products, like say a bond is a loan to a company, and you do have you know, uh, they have a liability to you. It's a different relationship. But as a stockholder, you're actually a partial owner, not a big owner probably, but still have an ownership position. So, yeah. So if a company wants to expand, yeah, they don't go into a bank and say, "Hey, I need to get a loan." They'll go to a big bank, one of the big commercial banks, and they'll say, "Hey, I need you to organize a bond sale on my behalf." And so they sell, you know, bonds. And so the way a bond works is, let's say a company wants to expand, they want some money, so they say, "Hey, we're going to issue a bond, 20,000 bucks, pays 5% maturity in 10 years." And so you go, "Yeah, that sounds like a good proposition. I'll buy that bond." So what you do is you give them 20,000 bucks. They pay you 5% of that 20,000 every year. And at the end of the 10-year period, they give you your 20 grand back. And that's that. So you don't own any part of that company. You're just making a loan to that company. Real estate, real estate's great investment, especially since for owning your own home. In my mind, that's kind of a no-brainer. Rental properties and land, that's you've got to do an evaluation to see if it's competitive with the other investments. But again, I do like real estate, and you don't have to have just one of these. I've tended to make money in the stock market and then been nervous about the volatility or the ups and downs, and decided to use those profits and buy land with it. And that's not bad. Crypto, yeah, not all cryptos are the same. Bitcoin obviously is. I've got a bunch of altcoins, which are basically everything but crypto or but Bitcoin, and yeah, scams. I already mentioned somebody tried to scam me and almost did a pretty damn good job of it, and that was on Coinbase, which is a legitimate, But anyway, if you get ripped off in Bitcoin, there's no Bitcoin help desk. You don't call somebody and say, "Hey, now Coinbase." I don't know. I haven't really explored it. I need to correspond with them a little bit more to find out exactly what happened. But yeah, and I'm sure I was not the only one that had their password changed and details all changed out on them. It's kind of scary. Okay, types of investors. So there's you and I down at the bottom. Individual investors. They also call us retail investors. Then you have the big boys. The institutional investors. So, yeah, that might be a union fund, employee fund, what could be, the Alaska PFD, the permanent fund dividend, their investments. Anyway, big investors. Then you have portfolio people, and these guys are kind of the mutual fund people and stuff. When I said, they own shares in all these different companies, and then they offer this product, those portfolio managers would also be a role like that. Returns from stock. So talked about dividends, and we talked about price appreciation, which would be reflecting the capital gains. So this is what I was saying before. Growth stocks, yeah, they grow. You see the price go up, and you sell it for a capital gains. Income stocks. Income is large dividends, right? That's where the income comes from. Slow, steady. People in retirement may want these, but you don't have to fit these molds. I mean, when they look at my portfolio, they go, "Wait a minute, what are you doing? You should be in income stocks." The growth stocks are for the young. Yeah, depends. Investing, return from investing in bonds. Yep. So that coupon, bond appreciation. We'll talk more about how bond prices can change. But yeah, that when I say they pay you 5%, that's cool. Now you don't have to take this bond all the way to maturity. You can sell it before or after. And say you've got a bond. I'll go through this quickly. Let's say you've got a bond that pays 5%. Well, they offer a new bond that's paying 4% this week. Well, all of a sudden, your bond that pays 5%, that's a better deal. So on the secondary market, you paid 20 grand for this bond, but it's paying 5%. You may be able to sell that for 21,000, for example. Conversely, if you've got this bond that's paying 5% and a new bond comes out and it's paying 6%, well, nobody wants your bond. You can sell it, but you'll sell it at a discount, or you can wait the 20 years and get your 20 grand out of it. When it hits maturity, they have to pay you back the full value, but you don't have to keep it to maturity. Mutual funds, just like stocks. So a little more complex, but that's easy. They just calculate all the shares and they determine where it went. Real estate, yeah, there could have been some income over time from if it was rental property, but largely due to the price. But there's also tax benefits for real estate depreciation. Again, you're not going to have to know formulas per se. I mean, they make this sound more complex than it actually is. I mean, that big R means the return, so how much money you're making. And go figure, P sub T and P sub T minus one. Well, yeah, the price you bought it for, the price you sold it for. They make it sound more difficult than it is. You can do this in your head. No formula required. Dividend, if they paid a dividend, yeah, you sold it for, bought it for 40, sold it for, bought it for 40, sold it for 50, and you made, a couple percent dividend every year. Well, you need to calculate in that dividend to see how much you actually made. Differing rates on tax returns. So I've hit this a little bit before. Interest rates on coupon payments, ordinary income, which is kind of the worst place you want to be. That's for bonds and stuff. It just comes down as income. But investments held less than 1 year, again, that goes in the ordinary income category. But capital gains over a year, now you're in the long-term capital gains. And this is typically down at 15%. So much better situation. Here, stocks, more than a year, less than a year. So, yeah. What tax rate are they looking at? 35% on short-term capital gains. So they're whatever. You know how tax brackets work now. And so if you're making, 100 grand a year or 150 grand a year, and you get a capital gain, well, that's going to be added on the top. So that's going to be in the highest tax bracket, that incremental income. So, yeah, it's not uncommon for it to be taxed at, more than twice the rate. Investment risk. So what you want is you want to make sure that the risk that you're taking is reflected in the return. There's nothing wrong with taking high risk if there's a commensurate high return. But if you're taking a whole bunch of risk with very little, and you don't know about it, then that's bad. Low risk is not always the answer because low risk generally means low return. That means you're treading water or perhaps taking on water if you're below the inflation rate. So small firms tend to have higher growth, but higher risk, certainly. Startups especially. IPOs, high return, but high risk. Yep. Among bonds, yeah. So we'll talk about bond rating and all that stuff. And bonds are rated. You should know what you're getting in on because there are ratings. There are some ratings for stocks, but they're pretty subjective. But you got to have a sense for it. But it's interesting. And like I say, I'm far more interested. I mean, I know very little about sports scores and stuff, but I know a fair amount about companies. And companies, the way they're priced is based upon forward-looking factors. Historical data is nice, but a stock is priced not on what they're currently doing, but on what their future appears to be. Mutual funds depends on the underlying assets. We'll go through. I'll show you how to see what the underlying assets are so you can make better decisions. Real estate, yeah, you can get great renters or flaky ones. Property values could decline if you select the right properties. Yeah, if you buy into a slum or a neighborhood in decline, that could be a problem. So you got to do some research, and we'll look at different investments here and try and determine. But the thing is, too, if you start small when you're younger, you'll have it pretty well figured out what works for you by the time you hopefully have real money to deal with, or maybe you'll make the real money from your investing. Investment mistakes, yeah, it's easy to get over your skis. People often talk about how much money they make. You can count on your hand the number of people on YouTube that talk about just how they failed. Everyone always wants to talk about how well they did. Leveraging on risk assets. Yeah, leveraging on real estate is kind of how it's done. Leveraging means using borrowed money. Leveraging on crypto, that basically means suicide. Taking risk to recover losses. This is just like this whole gambling dilemma where people, leave the casino in tears. Any investment, well, just about any investment, I much prefer than gambling. At least there's a chance to win. But not being aware of the investment, yep, not keeping up to, and certain things work, and then they quit working. Warren Buffett made a ton of money, but his investment style, it's not working for him any longer. I mean, he's semi-retired, but anyway. The term project, we'll talk more about it. This one's getting to be a little long since we reviewed the test and everything else, but the term project's out there. It's in the syllabus, so you can get a better idea. But anyway, for all you here in Alaska, I hope you're getting through your, hope you had a good spring break and are suffering through this weather. But that's about it. And we'll talk next week.